In this video, our expert will explain you what is IPO in brief.
Have you ever watched a well-known company, a brand you admire, or maybe even use daily, suddenly transition from being private to suddenly appearing on the stock market?
Yeah, it happens all the time.
It's that moment when a business, once kind of the domain of just a few founders and early investors, opens its doors wide
Yeah.
to the public, allowing basically anyone to own a piece. It's a huge leap, right? Often makes headlines.
Absolutely. And there's definitely far more to it than just, ringing a bell.
Exactly.
Yeah.
So today we're taking a deep dive into that exact phenomenon, the world of initial public offerings, or IPOs. We'll be navigating this pretty complex landscape using the material you shared with us, the AZ of IPOs, going public, which really seems to lay out the whole journey.
It's a great resource for this.
Our mission is to unpack this really pivotal moment for companies, exploring not just what an IPO is, but why a company chooses this transformative path, and the intricate process involved, and then what the lasting implications are once those shares actually start trading for the company and for potential investors like you.
What's really fascinating here, I think, is that an IPO is so much more than just a financial transaction. It signals this fundamental metamorphosis, really, in a company's identity and its future, its whole trajectory.
Metamorphosis, I like that.
Yeah, it redefines everything from its governance structure, its internal culture, even its public perception, and, its long-term strategic goals. We're going to explore the many layers of that transformation today, really digging into the nuances of what it means to step out of the, let's say, shadows of private ownership into the bright light of public scrutiny.
Okay, right. Let's kick things off with the basics then, the definition. What exactly is an IPO?
Well, simply put, it's that moment a company, which was previously privately held, meaning controlled by its founders, maybe some early investors, venture capitalists, makes its shares available for purchase by the general public for the very first time.
So it's the transition point.
Exactly. It's the moment a private enterprise becomes a publicly traded company listed on a stock exchange.
Okay. It sounds like a massive undertaking, though. I mean, inviting all that public scrutiny, mountains of paperwork sounds like a lot of work. So what really compels a company to take such a monumental leap? What are the driving forces our source highlights? Beyond just, the ambition of getting a fancy ticker symbol.
Yeah, the ticker symbol is nice, but the core motivations are almost always financial at heart. Primarily, companies pursue an IPO to raise a substantial amount of capital.
Okay, capital. For what specifically, usually?
Well, it's crucial for fueling really ambitious growth. This could mean expanding aggressively, maybe into new markets, or funding the development of cutting-edge products, R&D, that sort of thing, or simply scaling up operations significantly to meet demand.
Right.
It's also often used to shore up the financial foundation, maybe pay off existing debt, which can be substantial, or sometimes finance entirely new large-scale projects that would just be difficult to fund through private channels alone.
That makes sense.
And what's often overlooked, I think, is how the capital raised through an IPO differs from, say, private funding. Private equity or venture capital often comes with shorter time horizons, maybe more aggressive growth demand.
Right, they want their return quicker.
Exactly. Public capital, while demanding in its own way, we'll get into that, can sometimes offer a bit of a longer leash for genuinely ambitious long-term projects. It can really transform a company's strategic outlook for decades, not just a few years. It allows for a different kind of ambition.
That's a really crucial distinction. And for the people who got in early, like employees with stock options or the initial angel investors. An IPO isn't just about future growth for the company itself, is it? It's often the moment their years of, illiquid investment suddenly become something real, something they can actually cash out. That's a huge personal thing, isn't it?
Oh, absolutely. It's absolutely pivotal for them. For founders, early employees who maybe took equity instead of a higher salary, and those angel investors who took a big leap of faith years ago. Yeah, an IPO offers the first real chance to convert that illiquid equity into actual, tangible wealth.
Life-changing, potentially.
It often is. It's the culmination of years of risk and hard work, turning potential into realized value. But beyond these direct financial gains, there are also less immediate but equally crucial strategic benefits that the material points out.
Like what?
Well, going public can significantly boost a company's public image and brand recognition. Just being listed on a major exchange like the NYSE or NASDAQ, it lends a certain gravitas, a visibility that can be invaluable in the marketplace.
So the strategic benefits can be just as compelling as the financial ones. Maybe even more so in the long run.
Precisely. And that enhanced visibility, in turn, often makes it much easier to attract top talent.
Interesting.
Yeah, because it signals stability, success, and a clear future path to potential employees. Plus, being public can make it easier to secure future financing down the line, as public companies tend to have more transparent financials and a much broader investor base to tap into later.
Right.
So this raises an important question about how a public listing can actually serve as a powerful marketing tool in itself. Not just for products or services, but for the company as a whole entity, making it more attractive to everyone: customers, future employees, potential partners.
Okay, so once a company has made that huge decision, right? They're going public. It's clearly not just a matter of, flicking a switch.
Not at all.
This is where the real intricacies come in. It sounds like a marathon, not a sprint, needing a lot of specialized help. What does that journey actually look like from the inside?
Yeah, marathon is a good word for it. The IPO process is undeniably complex and it's highly regulated, which is exactly why companies almost never attempt it alone. It typically kicks off with the company hiring an investment bank, or often actually a group of banks, a syndicate, to act as their underwriters.
Underwriters, okay.
These underwriters are essentially the expert guides through this pretty labyrinthine process. They bring their financial know-how, their market connections, everything to the table. Their role is absolutely pivotal. They act as the bridge between the private company and the public markets.
A bridge, okay.
And crucially, they often actually purchase the shares directly from the company first, before selling them onto the public.
Really? They buy them?
Yes, which essentially guarantees the company gets its capital. But it also means the banks take on significant risk themselves if, the market doesn't respond as well as they hoped.
Wow, okay. So it sounds like these underwriters do a lot more than just give advice. What are the core responsibilities our source emphasizes? What really defines their role?
Well, it's definitely multifaceted. First, there's the critical task of valuation. They spend a huge amount of time assessing what the company is actually worth. That's crucial for figuring out the eventual share price.
Makes sense.
Second, they shoulder the immense burden of preparing all the regulatory documents. This is a huge part of it. For example, in the US, this involves the, notorious S-1 filing with the SEC.
You called it notorious. Why? What makes that S-1 filing so infamous? Is it just the sheer volume of paperwork, or is it something more profound for the company itself?
It's the absolutely forensic level of transparency it demands. Every single detail, and I mean every detail, from the founders' backgrounds, potential legal liabilities, market risks, future strategic plans, even exactly how the IPO proceeds will be used. It all becomes public record.
Everything. Wow.
Yeah. It's basically a complete strip down of the company, financially, operationally. And that's a massive cultural shift for a company that used to operate privately. It's infamous precisely because it forces a level of disclosure that many private companies find incredibly invasive, almost uncomfortable. But it's absolutely necessary to build investor trust and, of course, comply with the regulators.
Okay, that makes sense why it's notorious. And once that massive document is complete and presumably approved, they don't just sit back and wait.
No, exactly. Once the S-1 is filed and cleared, they transition into a very active marketing phase. This is what's known as the roadshow.
The roadshow, I've heard of that.
Yeah. This is where company executives, usually the CEO and CFO, often travel extensively with the underwriters. They meet with large institutional investors, think pension funds, hedge funds, mutual funds, other major players.
All of them.
Typically, yes, key financial centers. They pitch the company's vision, its financials, its future prospects. All the while, they're gauging investor interest and trying to build demand for the shares. It's an intense period, sometimes weeks long, of just constantly selling the company's story.
Sounds exhausting.
Mm-hmm.
So after all that, the exhaustive preparation, the regulatory hurdles, the intense marketing roadshow, how is the actual price, the initial offering price of the shares, decided?
That's where the art and science really blend. It's a critical step. Based on all the feedback and the level of investor demand they saw during that roadshow, combined with their own valuation models and market expertise, the underwriters ultimately set the initial offering price.
So it's their final call.
Essentially, yes, in consultation with the company, of course, but it's a delicate balance. They're trying to gauge perceived value against market appetite. They want to price it attractively enough to ensure a successful launch, make sure the shares get sold, but also high enough to maximize the capital raised for the company. They're trying to hit that sweet spot where there's strong demand, maybe even a little bit of a first-day pop, without leaving too much money on the table, by underpricing it significantly.
That's quite a meticulously choreographed dance, isn't it?
Yeah.
Just thinking about it, selecting the banks, navigating the regulatory minefield like that S1, the whole intense roadshow,
Yeah.
and then that final crucial pricing decision. Every single step is critical to actually getting the company effectively to market.
Absolutely. Every step matters.
And then comes the big day. You can almost imagine the excitement. On the day of the IPO, there's often a big ceremony, right?
Yeah.
Executives ringing the opening bell at the exchange.
It's very symbolic.
The company's shares are officially listed. They start trading on a major stock exchange like the New York Stock Exchange or NASDAQ. It really is the culmination of months, maybe even years, of intense work and anticipation.
A huge milestone.
And we often hear these stories about shares just soaring on the first day. Sometimes by huge percentages, it can feel like this massive win right out of the gate. Our material confirms this can happen, often due to really high demand where initial interest just swamps the supply of shares available. But I guess that initial pop isn't always the full story, is it? Must be a bit of a roller coaster for the company on day one.
Oh, absolutely, host. That initial pop is, well, it's a fascinating phenomenon. It's often driven by that pent-up demand and the limited initial supply. Everyone wants a piece of the new hot stock, right?
Yeah.
But for the company itself, while it's exciting, it can also be a bit of a mixed blessing. A massive jump might actually mean they left money on the table by underpricing it too much. Conversely, a sluggish debut or even a drop can send a different, less positive signal to the market. The real test, as the material suggests, really comes in the weeks and months that follow, after that initial hype inevitably subsides.
So the long game.
Exactly. If we zoom out, the IPO is really just the opening act of a whole new chapter. It's definitely not the end of the story. Post-IPO, the company must comply with really strict reporting and transparency requirements. This is a massive shift from being private.
How so? What does that involve, practically?
Well, they're now accountable to thousands, potentially millions, of public shareholders. This means filing detailed quarterly and annual reports, the 10Qs and 10Ks, providing regular updates on their financial performance, their operational status, any material changes in the business.
So it's just a constant stream of information going out.
Precisely. But it's actually more than just the filings. There's the constant pressure of quarterly earnings calls.
Right, the analyst calls.
Yeah, where executives are basically grilled by analysts about every decision, every projection. And the market's reaction to that news can be incredibly swift, sometimes unforgiving. It creates a completely different operational rhythm, a different pressure for the leadership team.
I can imagine.
And there's also the potential for increased scrutiny from activist investors who might buy up shares and then push for strategic changes they think will boost value. It really highlights that dramatic shift in accountability from a small group of private owners to the much broader public, demanding unwavering transparency.
Okay. And shifting gears slightly, for you, the investor, an IPO offers this kind of unique chance, doesn't it? To get in on the ground floor of a potentially successful company.
Potentially, yes.
It's that moment when a company that might have been totally out of reach or maybe just unknown to the average person suddenly becomes accessible. You can actually buy shares in it. The dream, of course, is you invest early in the next big thing, the next Google or Amazon.
That's the dream. However, this raises a really important question about risk. And the material is very clear on this. Investing in an IPO also carries significant risk.
Okay. Why specifically IPOs?
Well, while the potential for high returns is certainly there, that's the lure, new public companies can be incredibly volatile. There's often very limited historical public data to go on. You have the S1, but not years of public performance. And that initial pricing, despite all the work by the underwriters, can sometimes be overly optimistic, maybe hyped up.
Right, driven by excitement rather than fundamentals sometimes.
Exactly. It's just a crucial point for any potential investor to remember. The excitement surrounding an IPO doesn't negate the inherent risks of stock market investing, especially with a newly public company that's still kind of finding its footing in the public market glare.
That's a very important caution.
Yeah.